Hey, welcome back, friends. We'll now delve into Basel 2 norms, and this is one of the biggest part for the FRM Part 2 exam. So the things that we would be talking about are the difference between the original accord and the Basel 2 accord, the three pillars, three tier capital, different types of approaches, standardized approach, internal rating approach, how operation risk is addressed in Basel 2, that's something new, and a lot of interesting thing. One thing that you need to be careful about here is that there are a lot of things that you think is uh, is to be memorized, but that's not the case. So you need to just understand the thing. So we'll start with what does banking regulation mean. Regulation refers to the oversight provided by an external party with the ability to influence the legal and operating structure of the industry. Implicit in the decision to regulate is the trade-off between cost and benefit of regulation. So within the banking industry, the necessity of regulation is subject to debate, while some argue that the financial institutions should be treated no differently from other firms. That is, they should be allowed to fail. Most people believe that the potential cost of bank failure is too large, so they become too big to fail, too important to fail. Scope of regulation can vary significantly from systematic, that is the assurance of global banking stability, to micro level, which is protect consumer and investor. So there are four reasons that are given to justify the existing regulations. One is to protect bank depositors from loss in bankruptcy. The second is providing stability for transaction. Then avoiding contagion effect, because when one bank fail, other affect. That is also known as contagion effect, domino effect. Something like everything is being tied up with one another. Maintaining stability in the economy. So these are the four reasons given to justify banking regulation. Now when we look at the deposit insurance, so Federal Deposit Insurance Corporation guarantees a return of deposit in extreme case of bank insolvency or failure. While the system reduces the risk of depositor, there is also negative effect in that it reduces the incentive to the same depositor to monitor the financial strength of the bank. The depositors can have a safety net from deposit insurance and will provide less oversight than they would do in the absence of deposit insurance. The bank also faces a moral hazard problem, as the deposit intervention can increase a risk-taking behavior. The bank has increased incentive to take more risk without an insurer because the bank does not fully bear the cost. So in short, deposit insurer reduces the incentive of the depositor to monitor the bank. Since their funds are guaranteed, and bank will increase their risk profile. So that's another way to look at it. Now there's something called the too big to fail doctrine, which says that large firms on the brink of insolvency will create a contagion effect if they are allowed to fail, and this threat is large. The government is inclined to prevent the collapse of this from happening. This is called the too big to fail policy. In the event of failure, government would be forced to pick up pieces. Therefore, offering liquidity to prevent this from occurring is a better option. Intervention by the government creates a moral hazard where large business have reduced incentive to monitor the risky behavior. Recent example of company deemed too big to fail was the AIG, or the American International Group. So we start this with the history of Basel 1. So the intent of 1988, which is like 25 years ago, Basel Accord, or known as Basel 1, was to strengthen and standardize the global banking system. The exception was that individual countries would implement the basic frameworks of the accord and modify appropriately for the respective markets. The primary contribution of the 1998 accord was the establishment of standardized capital level built upon a risk-based definition of capital, that is, all assets have the same risk. Accordingly, assets were sorted out into four categories or buckets based upon their risk exposure. Organization for Economic Cooperation and Developments, OECD, sovereign, that's 30 developed countries, were considered least risky, while corporation obligation carried the greatest risk. The risk, the obligation, the more the capital bank was required to hold. The court stipulated the cookie ratio, or the capital to risk weighted asset, must not exceed 8%. Sorry, must exceed 8%. So you need to have more than 8% of the capital upon risk weighted assets. So you cannot let your capital run down. Basel I was later amended to take into account differences in market risk and allow use of internal models to measure market risk. This allowed better measurement of risk and more efficient allocation of capital, since banks could hold less capital or lend more based on a given level of capital. With Basel I particularly, the risk-based capital approach was a significant improvement in the sophistication and standardization of risk measures. Several important clues were left unaddressed. So those things that were not addressed was like the clear rationale of using 8% cookie ratio, and the risk budget for homogeneous, like all corporate bonds face the same risk. Cookie ratio was too simple and to truly evaluate the solvency level. Potentially risk-reducing derivatives and load portfolio was ignored. Off-balance sheet activities to mitigate risk exposure was not recognized. So these were things happening in the Basel I, that's 1988, and which was originally developed to cover credit risk capital requirement. In 1996, it also included market risk. And in 2004, the Basel II included operation risk as well. So it started with capital to market, and then from 2004, the Basel II had all of three. So the Basel II Accord is aimed at large international banks and all subsidiaries, holding companies and security firms under the parent firm. The primary goal of Basel II is to provide more precise qualification of risk level between banks. Since banks greatly varied in sophistication and credit exposure, the bucket approach of Basket I was deemed both simplistic and ineffective. In addition, the committee sought a system flexible enough to accommodate rapid changes and the innovation in the financial market, as well as risk management practices that were lacking under Basel I. So ultimately, Basel II established three options for calculating credit risk capital requirement. So the credit risk capital, so as you remember, credit was the first one to come into picture, and the Basel II established three options. One is the standard approach, which is essentially the same as under original Basel Accord, but the risk weighting are based on characteristic of each borrower and provided by external credit rating sources such as S&P and Moody's. So you have a matrix, if you remembered, where different ratings are given and a probability of default is given. The internal rating based IRB foundation approach is hybrid of internal and external. Typically, the banks use internal estimate of default probabilities and use external sources for model inputs such as loss given default. Regulators often provide the latter information. And the third one is internal rating based approach or advanced approach. The bank generate all estimates used in the model, so they take no inputs. So first was where they take all the inputs from the rating agencies. The next was like they use their model, but the inputs were from the regulators. And the third one is like they used everything on their own. So these were the three options for calculating the credit risk capital requirement. Now Basel III also recognized three pillars of sound bank risk management, and pillar one is like a highly quantitative assessment of capital requirement for bank. Also the main focus of this pillar is credit risk, operation risk. Pillar 2 envisions a formal role of regulation in effort to identify and stem potential problem. The regulator will provide a credible check for inputs used in the bank models. In addition, frequent monitoring allows for intervention earlier rather than later in a corrective action is needed. And pillar 3 focuses on capital requirement as external monitor of banks. So these were like the three pillars. So again, continuing with the capital requirement. So the most basic form of capital requirement is total capital upon total risk weighted assets, and this is the required capital or the capital that you should have. So under Basel 1, the risk weighting were based only on credit risk, whereas Basel 2 takes it for credit, market and operational risk, and this is known as the capital ratio or the capital adequacy ratio. The total risk assets are broken into market, credit and operation risk. According to Basel 2, a bank's capital ratio must exceed 8%. This mandate 8% capital is used to determine the capital charge for a given risk. For example, capital charge for credit risk is computed as 8% of risk-weighted assets for credit risk. In order to compute total risk-weighted assets, we start with risk-weighted assets for credit risk. Then the calculation for risk-weighted assets for credit risk is simply the sum of credit risky assets multiplied by the corresponding risk weights. Then we add the capital charges for market and operation risk. Method for calculate that is to multiply it by 12.5. So we need to determine the risk-weighted asset for market and operational risk to divide the capital charge amount by 8%, or we can multiply it by 12.5%. So for example, suppose the risk-weighted asset for the credit risk for a company is say 150, and if we assume that the market risk charge is and remember this is market risk capital charge or requirement is 30, and operation risk capital charge or the requirement is 50, then the total risk asset is 150 plus whatever the risk capital requirement into 12.5, because this must be 8% of the total capital. In this way we can calculate the total capital, and then from that we can calculate the total capital the bank must hold. So this is how we need to convert things using 8% or a multiplier of 12.5, whether it's requirement or it's the total assets. Now the numerator that we use which is the required money, it can be different things. So let's look at the standardized approach. The standardized approach under Basel 2 assigns a risk weight to each asset on its credit risk. An asset assigned risk weight from 0 for high quality sovereign debt to 100% for corporate debt based on its credit rating. Since 8% is the capital requirement, this serves as benchmark for calculating the capital distribution for each asset. So for example, we have a AAA rated and a BBB rated bond, and the risk weighting for a AAA rated bond would be like 20%, and risk rated for a BBB rated bond would be like 100%. So based on that, the capital requirement on this would be the amount of that we have into risk weight into 8%. So for a AAA rated bond we need to have less amount in our basket, whereas for a BBB rated bond we need to have more amount into our basket. So if it's a BBB rated bond and it's 100% weight we have to keep, then we have to keep 8% of that into our basket. So that's how we use the percentage weights for calculating the capital that we need for different bonds. So just remember that even if AAA corporate bond or a sovereign debt, we need to have some capital, which is the 8, which will be not the 8% but less than that, but it would be some. So that's how it would work. So an important change in Basel 2 relative to Basel 1 is that previous distinction between OECD and non-OECD sovereign debt. So previously OECD sovereign were assigned risk weighting of 0. Under Basel 2, credit rating of them is determined on case-to-case basis. So that was one area. Now IRB approach. The IRB approach has potential to reduce the capital requirement for bank because their own risk may be lower than those calculated under the cookie ratio philosophy. Some of the benefits from switching from the less standard may be delayed because the capital requirement cannot be less than 90%, because the capital requirement under IRB cannot be less than 90% of the capital requirement of the previous or 80% of the prior requirement after 2 years. So risk weighted is based upon potential exposure at default into capital requirement. So risk weighted asset would be capital requirement into 12.5 into exposure at default. So we are into the IRB approach, which we are using to calculate the risk weighted assets. Then we calculate the probability of default and loss given default and do a long method. So we'll skip IRB method for now, and we'll move to something which is the comparison of standardized and IRB approaches. So collateral deducted from EAD under standardized method, yes. Under foundation, no. LGD estimate, we don't get that in the standardized method. In the foundation, we predetermined and decreased with seniority. Under advanced, we take on our internal estimates. Probability of default estimates, we take rating agency in standardized, concave PD function and concave PD function in the advanced and foundation. Maturity adjustment, we don't take in standardized. Effective maturity is assumed at 2.5 years for foundation and adjusted for maturities based on probability of default in advanced. So we do a lot of customization, and we can choose things in the advanced IRB, and we can choose maturity adjustment, probability default, which is a concave probability of default function, and loss given default estimates. So now we move to the last part here, which is credit risk mitigation and securitization. So banks that employ the standardized approach can further adjust their capital requirement to reflect the reduced risk in the loan portfolio from the use of collateral, guarantee, hedge, swaps and other derivatives. The specific rule, as you can imagine, are quite detailed, but the general principles of credit risk mitigation are straightforward. Highly liquid assets such as cash, gold, estimates, equities and indices can be considered collateral. The bank may also be able to use on-balance sheet netting if a legal basis exists and accurate netting can be determined. Criteria for using guarantees and credit derivative to offset credit requirements are more stringent due to complexity and specific condition of the contract, timing of the cash flow and potential asset liability mismatch. Securitization is considered an acceptable method for credit risk mitigation under both standardized and IRB approach. However, committee makes an important distinction between traditional and synthetic securitization. The primary difference is that traditional securitization dictates the assets are in pool are truly separate from the bank. Synthetic can reduce capital requirement if the underlying credit meet the previous standard for CRM. Under the standardized approach, the same weight scheme described for capital requirement is utilized, and institution employing IRB approaches can compute capital using rating based approach or a supervisory formula approach as told by the Basel committee. So that was part 1 of the Basel II norms. Although I have been a bit fast, but I hope you find it useful. Thank you.